Hello, everyone. Welcome to part 3 of Show Me the Money. This is the third episode of 4 episodes designed to teach entrepreneurs everything they need to know. Well, not everything, a lot of what they need to know about finance for your entrepreneurial endeavor. I am welcomed today by my good friend, Miss Stephanie Sims. How's it going today, Stephanie?
Oh, it's great, Carmen. As always, it's a pleasure to be with you. And I am excited that we've got Terry Robinson with us today from Sunovis Financial because I have some experience, but I think this is the guy who can tell us everything we need to know about debt, credit, and borrowing money for your business. So it's going to be great.
Awesome, and I've enjoyed getting to know Terry back in the green room. But Terry, welcome to Show Me the Money, where we've kind of put this out there to let entrepreneurs know that the money that they're looking for is all around them. They just need to know how to find it, how to earn it, and how to hold on to it. And so that's kind of what our 4-part series is going to be talking about. The first one was about personal finance and budgeting. The second one we did last week was about crowdfunding. And this week we're talking about debt and credit. And the next week we'll be joined by TK Kugler, who's a venture capitalist, and we'll be talking about venture capital. But not to get ahead of us too much, I would like for you to go ahead and introduce yourself, tell us about you and your business, and then we'll get into some questions.
Great. Thanks. Thank you, Carmen. Thank you, Stephanie. Glad to be here. Terry Robinson. I'm the founder of Sunovis Financial. We also have a division called SBA Loan Advisor. We're a specialist in working capital loans and equipment leasing, other products. We are trusted advisors to help small business owners and entrepreneurs find, the best equation for them to help them grow their business and do it without falling into the many pitfalls that, small businesses have when it comes to looking at, different debt vehicles. So that's what we specialize in, and I appreciate being welcome to this hangout today.
Well, thank you so much. I appreciate you're coming on, and you promised to be open and candid about everything, so nobody have any fears. And that's one of the things that I wanted to go ahead and just hop into the questions with. I think there's a lot of perhaps fear out there resulting from recent financial downturns and all of that about debt and about credit. So let's just start off with just a general question, and we'll probably define it a little more narrowly as we keep moving. Is all credit and debt bad?
Oh, absolutely not. I think that, what happened is in 2008 when we went through the credit crunch, we had to develop a new way because basically we had a very closed market and access to capital markets and even the banks were pretty much closed down. So a whole new breed of lending grew, and that's pretty much what we call the alternative or non-bank market. But what happens is the same group of people that kind of fueled our crisis, they actually moved into the alternative lending market, which is one that has a perceived and sometimes very well perceived higher cost of credit, and it has a lot of gotchas. So there's been a lot of bad things, and I'll just say it up front, a lot of bad things that happened because out of desperation, business owners weren't able to access the working capital they needed, so they were forced to utilize credit vehicles, debt vehicles that they shouldn't have been in the first place. So, moving a few years ahead, the good news now today is that there's a lot better choices and there's a lot better ways to structure solutions for business owners than there has been, since the crisis. And what we want to do is just educate people on what those look like.
Okay, and that's great that you mentioned that, because I think something else that people are concerned about is they look and they don't really understand the differences between the types of products or loans that they're being offered. So could we maybe, I kind of see maybe 3 different groups, but we didn't talk about this, maybe you see more or less, kind of the big categories of the types of loans people could get and maybe some advantages and disadvantages of each one.
Sure, yeah, absolutely. When we started a couple years ago, we really focused on the working capital product. That was basically a loan. It's a loan that works with maybe a daily ACH, weekly ACH, even a monthly payment. And basically, it was simply a cash flow loan. In other words, what was the cash flow of the business, and how healthy is the business, and what kind of debt service can this business support? I mean, there's other factors, obviously, in the underwriting decision, but the basic structure of the loan is that. There's also what's called the merchant cash advance, which is a very actually old and aged industry. It dates pre-2008 by years and years, decades. And so simply what that type of loan is that what we do is we hold back a very small portion of the actual credit transactions, Visa, MasterCard, Discover, things like that, and they can actually pay that through their transactions. The nice thing about that is that it allows the repayment cycle to go through the cash flow cycle. So if they're down 1 month, they're not fixed to a payment, which could actually put the business in a very bad position because they can't service that debt. So that's your merchant cash advance. But then there's other lending products such as, equipment leasing. So if you've got a restaurant that needs, some new equipment, that's some of the most attractive rates out there right now. They beat even SBA loans. They're so competitive. SBA loans are another product. Purchase order financing. I could go on a few. I'll just stop though. But that's kind of the bandwidth of selections that you have today.
Okay. Well, and can I just ask you one question? It's kind of a clarification. It sounds like what happens is when what you have to secure or to guarantee the loan is something that's an asset, like a stove for your restaurant or a car because you're, a van, a delivery van, or something like that, you're able to get better rates. But does that mean you're actually able to get the loan, that it's easier to get the loan? Or is it just that if you qualify for the loan, you get a better rate when it's what I would call asset-backed, when it's connected to something tangible?
Yeah, that's what you're saying is a good point, because an asset-backed loan is going to generate better terms, such as equipment financing, and we have strictly working capital loans that can take the tangible assets of a business, and you're typically, because it's a lower risk loan, you're going to secure better terms. But a lot of business owners do not want to encumber themselves or generate additional risk by things such as personal guarantees, because there's guarantees, and then there's loans that have no personal guarantees. So the more risk that the investor takes, the higher obviously the cost of credit.
So my question is, you've outlined several different kinds of debt. It sounds like there are better times in the life of a business for different kinds of debt. And it sounds to me that perhaps in the startup phase, at that very, very beginning, you don't have any customers on the book, but you got to have some capital or some kind of cash to get going, that you should probably expect to have a higher interest, or it's a riskier loan for an investor. So could you explain a little more about, as you go through kind of the life stage, like what would be a good option for somebody that's just getting started versus somebody that's 3 or 4 years in versus somebody that's in a mature business?
Right, yeah. Yeah, it's kind of an evolutionary cycle of different, rounds of credit. That's the biggest challenge, is how do we get started? How do we bootstrap this business? And you can look at personal savings, or do you use your credit cards or your personal credit to get the thing off the launch pad? SBA can help, but a lot of times you need to have an equity position. You need to have a very strong personal financial profile to obtain an SBA startup loan. The good news is that when I was doing this 3 years ago, if you weren't in business for at least 1 year, there was nothing I could do for you, because I really worked in helping existing businesses with expansion capital. That was what my focus was. The thing about it today is that we have credit facilities that will go all the way down to 3 and even 2 months. So if you've been in business now for 2 or 3 months and you can show some, sound cash flow management, just you're making money and the trend line looks good, I can help people now. I couldn't do that even 6 months ago. So those are some positive developments. So, you're going to need to figure out if it's crowdfunding. Is it, using your own personal savings to get the thing off the launch pad? Is it an SBA loan? Once that happens, then you start opening up the bandwidth of opportunities in terms of what's out there. It becomes wider and wider and wider as the business begins to evolve to the positive level. There's so many different products that are better and better as the business becomes stronger.
Well, and I like what you're saying, Terry, about the fact that the options keep changing, right? As the market evolves, there are different options. But as an entrepreneur, what are the things that we can do that can help us access those options? We kind of talked about this in the green room, the notion of going to the bank hat in hand, for example. That whole model just really doesn't do you any favors in the lending market. But what are some other things as an owner that we can do that are going to make us attractive to lenders?
Yeah, I call that my get ready to access credit. That's where one of the biggest challenges I see is that businesses wait until they're sitting at the precipice and they're looking down at the I'm not in business canyon anymore, and that's not where you want to get a loan, because there is no money down there. So we want to back up a little bit and get the business where it has sound cash flow management. In other words, if you're going to go to the bank and you have NSFs on your operating account, do you think that you're in a position of leverage? No, the answer is absolutely not. So what I tell all of my clients that I advise is that really you want to think about, I need to access capital at any time. So you may be a robust business and you have plenty of cash flow coming in. I still ask my clients to think that today, for some reason unknown in the future, maybe it's they have an opportunity to capitalize on something that has just come in their way. Maybe they buy the business that's down the street and it's in a similar business, so there's an expansion opportunity. But they need to get ready to be able to either buy that equipment to get the working capital they need, and they need to be able to do it at any point in business. And that means also keeping, sound records, keeping everything ready to go, keeping the business credit strong. Looking at your personal credit is also something that you want to maintain a high credit score. So in other words, when you make your presentation to whoever you're going to approach with your working capital needs or any kind of credit needs, that you're in a position of leverage, not them.
Okay. Well, one question I have, I think there's kind of this old school, well, you tell me if it's old school, this idea that, working with banks and all that kind of stuff, that it's like a buddy system, it's who do you know at the bank, and if I know the loan officer, I know the president of the bank, then I can go in and, if I play golf with the right people, that I can get the right kind of a loan, and if I'm not that person, if I'm a single mom and I want to turn my cookie business into, the next Sara Lee, then they're just not going to, they're just going to look down their nose and laugh in derision. Is that really, what it is? Or what do you think gets you lended, I guess is the right way?
Yeah. Well, that good old boy thing, I think, is kind of a misnomer. Even if you're a pro golfer, it's still not going to guarantee a loan. You're probably still not going to get the loan at the bank. And the good old buddy system is pretty much dead because the bank's hands are tied due to new, regulatory environment that they find themselves in. So going to your bank has about a 90+% denial, even if you've been with the bank for 30 years and you have capital in the bank that actually exceeds the credit request. You still have about a 90% chance that you're not going to be turned down. I see it all the time with the contacts that I have in banking, because I've worked in, obviously, the banking world, and they're just challenged with saying, hey, I know you've been with the bank for 30 years, but look, my hands are tied. We really can't lend. So what you find today is a new breed of business lenders that are filling that void with very, very competitive rates, and some that are actually right at the bank level credit terms, and they use technology. So that the good old system has been, the good old buddy system has been replaced with the more modern algorithm on how to underwrite loans. I mean, the modern one, the good old buddy system, is part of it is they look at maybe even your social metrics. You know, how good are you at the digital marketing strategy? Because that is one of the elements now of underwriting, which is unheard of 2 years ago even. But that's how investors are looking things. How good are these people with their you know, their expert positioning? How good are they with their social media footprint and things like that? So to answer your question it's a whole different world. It's a lot more impersonal. They look at just basic data points and they run it through a very quick decisioning engine, and that's how it's pretty much done today.
And just to follow up with that, Terry, for people who maybe don't understand at a kind of higher level how lending works and why the banks have their hands tied, as opposed to some of the other people that we're talking about, I'm just thinking we can try to help them understand. We're talking about presenting yourself as an investment, right? You know, we keep saying you want to present yourself as an investment. And maybe for people, they're saying, well, wait, I'm going to the bank. I'm not going to a venture capitalist. And I think maybe we could speak a little about how the bank runs their business, right? Like, what's the bank's business model? Who are their customers and who are their vendors, if you will, which is kind of how I see a business that comes in. You know, the bank sells a product. The bank sells a return to the people who put their money in the bank. And you, as someone who wants to borrow, are like a vendor. You're offering them an opportunity to generate their product, which is a return on the money that they owe to their clients. So that's where, you know, the notion of risk and reward and why it costs more in certain places might help people understand. I don't know.
Yeah.
Well, and real quick, I'm sorry, just before Chris answers that, I was going to say, I am totally going to quote you on saying that digital marketing matters. Even when you're going to seek credit and all of that. So I would think that having good social media presence, showing that you can attract customers, which is what marketing does, is a good thing for a business. That's all I'm going to say, and I'll let you answer your question.
Well, you know, I have to agree wholeheartedly. So, yes, everything you said, I agree with. I'm shaking my head, and it's part of the underwriting equation. So,
go ahead and answer Stephanie's question.
Okay. Meanwhile, back to the bad bankers, bad bankers. And they're really not bad people. They're just people that are there trying to do their job, and they're very limited in terms of what they can do. They got these handcuffs, kind of like Dodd-Frank kind of thing. You know, it's the new regulatory environment that they find themselves in. And you know, I actually feel sorry for them, because imagine coming to a client that's been with the bank for 30 years, and they actually have a very high value relationship in terms of, you know, they might have $300,000 in deposits, and they say, yeah, for that $30,000 loan, I can't do that for you, even though you have $270,000 more in deposits. How do you think that delivery went? So yeah, so you got to feel a little sorry for the average banker, because they really have not a good position to be in. They've been closing credit lines and working capital, calling loans due. And you know, it's because of what comes out of the regulatory environment. So fast forward is we have a new breed of non-bank lenders that are not under this new regulatory environment. They can operate more freely to generate credit to small businesses, and that's what has pretty much taken up the slack in business lending, you know, for the last 6 years or so. And they can look at something in a more make sense environment. And basically, it's not rocket science here, even though you talk about algorithms and underwriting engines. It's like, if I make this loan, can this person repay us? And that's all they really want to know. That's why the underwriting goes so fast. I mean, I can literally get approvals within 24 hours. We can fund within 4 days. You try to go to a bank, even if you did get it, you're looking at a 90+ day process. So that's, I hope, did I answer the question in terms of, you know, kind of why the banks where we are today, banks still haven't been able to fill the void because they're not going to do it. Those regulatory compliance is still in effect, and that's where it's going to be for probably the next 5-10 years.
So then why would, you gave the example of a bank that may have 300, or excuse me, a customer who has $300,000 in deposits and is asking for a $30,000 loan and gets denied. It would seem to me that there's not much risk in that. So why would a bank not want to fund that?
Well, like I said, it's not even about the risk-reward scenario. It's more about the regulatory and compliance environment that they find themselves in. And what that means is it doesn't make any sense. But that's what we find from our leaders in various places. They have made it so difficult for the banks to actually make sense anymore. So we now have gone to this whole crop of other credit facilities, and you got crowdfunding, and you got non-bank loans. We even have non-bank SBA lenders that are nonprofit, because the committee who's going to issue the approval on an SBA loan, they're so afraid to do anything that might get them in hot water. So nobody does anything. Nobody makes any decisions. And that's kind of it's like the deer in headlight bank syndrome that we find ourselves in right now.
Well, and something that I found interesting in my own personal experience, because I am, like many people that are watching, I would imagine, I've just started a new venture, 6 months ago, and right now we're still not breaking even, right? We're still not making money. And so I went to my bank and I said, what can you do for me? And what I found interesting was that they didn't say no, and they said, we'll find a way to make it work. But when I listened to what they were saying, really what they were going to do is create a personal guarantee, meaning that I was essentially doubling down by betting my personal assets against my business. And the problem that I had with that is, yes, if I choose to do that, well, that should be my choice, and it's great. But I wasn't, had I not known about lending, I'm not sure that I would have been really clear about that when they explained it to me, because they're in a situation where they have to make a return on the money that they've got, right? So they've got people who've given them money to invest. They need to have that money working. But a lot of times, in the interest of trying to make something work, I think people don't always get the information that they need to make the right decision, right?
Right.
Because that's what, I think it would be great if you talk to us maybe a little more about a personal guarantee and what that really means, because I saw it and it made me nervous, right? And I was like, no, that's okay. I'll find the money somewhere else. I don't want a personal guarantee. But Could you tell us a little more about that?
Yeah, that's the in the contract. We want your first child and your golden retriever clause. Yeah. So, personal guarantees. If you don't, and can be very intimidating. And it's not uncommon. That's been just probably a staple of lending. Is that if in the event that you default on this loan, one of their recourses is to go directly to you to say, hey, you promised us you're going to pay us, and we want you to make good on that. So whatever your assets are tied to you individually and not the company is also going to be open for our recovery. And that's just not an uncommon thing when it comes to lending today. Now the advantage with the new breed of lenders is that there is ones that have less onerous personal guarantees and maybe limitations when it comes to what exactly that means. Because that's what I would ask. Well, what does that mean? If I'm going to have a personal guarantee, exactly what can you define that for me? And that's the kind of questions that you would want to ask any sort of lending offer made to you. Does that limit myself to, the investments that I have in terms of stocks, or you're going to come and take my car and the house and the dog? Where does it stop?
Well, can you raid my personal checking account and all of a sudden I go to buy groceries and there's nothing there?
Yep, exactly. So,
just as a follow-up to that, and I know you have a ton of expertise in SBA, but my understanding was that almost every SBA loan requires a personal guarantee. Is that still the case?
Yes.
Okay. Right. And
so that hasn't changed.
And so what's so funny is that people feel like there's this security in an SBA loan and somehow it's going to be easier to get. And really all that's happening is they're the person that's guaranteeing it, right? Because you're putting your personal assets at risk when you get either a plain bank loan or an SBA loan. So,
right.
You know, what I guess the question is, what's the advantage of getting an SBA loan? Is it just based on the rate? You can get a lower rate?
Terms are much more preferable because you're dealing with a government guaranteed loan. Now, SBA loans, the other misnomer is that it's not the SBA that's issuing the actual loan. It's banks and non-bank approved SBA lenders, but the government guarantees that particular loan. And so if in the event that you would default on it, the government steps in and secures the interest of the lender. That's why the terms are so superior to virtually any other lending product out there. You got prime plus a couple of points, and there's a spread depending on exactly what SBA loan it is. And obviously I'm not trying to steer anybody away from an SBA loan, but unless you're really prepared for it, the SBA can be, for a larger SBA loan, a more difficult process, and you were going to need probably a larger balance sheet of personal assets and a higher credit profile. But that's why going back to the personal guarantee, that's why reading the fine print on any of these and asking the right questions, because even in alternative lending such as working capital or the merchant cash advance, there's UCC filings, and most people don't understand what a UCC 1 is, and that's basically a blanket recovery instrument that you're agreeing to, that if in the event that you default on the loan, you might see all of your restaurant equipment at the auction house, and you're agreeing to that. So you need to be eyes wide open going into what the particulars are in the instruments.
Wow, that it makes my tail tingle. If you saw like,
I'm sorry to go on the somber side here of lending, but
But I mean, I think that's where a lot of people got caught. They didn't know, and they found themselves in a situation where like you said, they had that UCC, there's a UCC. And they own a restaurant and they got behind on their bills and just figured, okay, I'm behind, and then came in to open the restaurant one day and there's no stove, all your stuff's gone, and didn't realize that was what was in there. And then it made the business unrecoverable because now you're, going to do a lunch service and you got no stove, instead of being aware of the situation ahead of time.
Yeah. That's the no more cooking hamburgers for you clause, and that's you want to look out for that, and just be aware that there's other parts of a contract. If you get into alternative lending and let's say you don't meet the required daily or weekly payment, what happens then? And there's a lot of pitfalls in terms of, there's a bandwidth of not so bad to they basically have the right to accelerate the loan due immediately once you have basically have a breach of contract, and you haven't fulfilled it by missing one payment on that. And I have heard horror stories where basically everything has been drained from the account. The processing system has basically been locked out because there's these things called lock boxes when it comes to the merchant processing account. So you want to think through all of those things and make sure that you ask the right questions, and then determine if it's a risk that is palatable to you before you actually sign for the loan.
Well, and I actually have seen personal guarantees a lot on credit cards as well.
Right.
Yeah.
Right.
So, yeah, and then that's that fine print you're talking about that they don't always tell you. We're about halfway through the show. In fact, we're exactly halfway through the show. So I just wanted to pause, let everybody catch their breath for just a quick second, and just remind everybody that you are watching the third of 4 installments we're calling Show Me the Money. We are helping entrepreneurs and business owners find the money that they're looking for keep it where they want it so that they can use it for the things that they dream about, and that's growing businesses and furthering life's goals. So we are here with Miss Stephanie Sims and our special guest for today, Terry Robinson of Sunovis Financial, and we are talking about credit and debt. We've been talking about kind of maybe if you want to call it the darker side of credit and debt, you know, the things that go bump in the night when we talk about credit. But let's talk about maybe some of the upsides. And I've heard that there, you know, how can a business leverage their credit or debt? You know, what kind of a scenario could a business look at credit and debt as saying, this is going to help me get ahead faster, better, stronger than maybe my competition or you know, whatever their goal may be?
Right. Well, you know, it's a mathematical equation. I don't mean to seem like it's dry and everybody says, oh gosh, you know, here we go. Here's the banker speaking in terms of, you know, just pure numbers. But, you know, this really, it's just, is this good for me or not? That's basically all it is. And what I try to help people in terms of determining whether or not that they should be doing this is we look at it through just kind of a real simple economic model. Is this going to help me fuel my business or is it going to harm it? And I'll give you an example of a recent loan that we've done for an electrical contractor. And it was kind of a good old boy, had a 30-year-old business and very, very, very good cash flow. And he just doesn't like loans. Just bar none. I don't like loans. I don't like lenders. I don't like you. Not you personally, but you know, he was just saying that you're kind of like a necessary evil. I've had those conversations and they say, you know, I just want to actually try to make this business grow by myself. And I say, you know what, if I wasn't needed, that would be fine with me. But the thing is that we find our system where I'm the fuel, I'm the working capital, help your business thrive. And I want to find the right investment, you know, the right vehicle as kind of co-investing in the business. That's the way I look at it. I want to be a lending partner. So let's say that, like on this electrical contractor, he had an opportunity to buy out another failing contractor, which would have expanded his business. He needed some new equipment, and we basically started doing kind of the A-B scenario. A, without me, taking, you know, your current scenario, where are you going to be at the end of 12 months? And then the B scenario was, here's the cost of credit. Here's the capital that you're working with. Here's the things that we could look at in terms of beneficial components, you know, buying that other company, getting some of the new equipment, you know, expanding some of the territory for the business. And then we ran some very basic what-if scenarios, some basic, you know, modeling on with the bandwidth, the productivity and profitability. The answer was, even on the low end of our modeling, let's just say we didn't do very good at any of those things, it was still a positive equation. So I basically came down to, so I can help you get there faster, you know, is that something that you want to do? And he kind of looked at me and said, yeah, where do we begin? So that's you know, what I help people do, where most loan advisors, they're in it, you know, to, you know, make loans, and they don't ask questions in terms of, hey, is this really in your best interest? And we at Sunovis Financial do not believe, and we do not operate that way. We truly are wanting to be the trusted advisors, and oftentimes throughout our whole company, we'll look at a scenario and go, we do have an approval for X dollars, but we take a look at the profitability of the business, and we just take a couple of basic numbers and go, that doesn't make sense for you. That's actually going to gut out the business and leave them with nothing but something that's on the dark side. So I think that the answer is no today for the loan, and what you should do is probably work on some of the other basics, you know, expanding your business, work on some of the fundamentals, work on your, I gotta say it again, your digital media, you know, initiative and other things. You're gonna really love me after this. I gotta tell you, you owe me the first cup of coffee.
Awesome. The next time I'm in Montana or Idaho, I think is where you are, you said?
Yeah. It's a long flight, isn't it? So, you know, it's one where we just want to be a long-term partner in their success. And that means doing the right thing for the right reasons. And that's why we look at things differently than other lenders.
Well, and I think, that's also part of, what Carmen and I are trying to do is help people understand that even though it's an intimidating process, and even though you may have all these kind of misconceptions or these things that make you afraid about lending, it's better to understand what your options are and to try to find people who can help you think about it in a way that's going to give you the points to make the decision that works for you. Because like you said at the beginning, debt is not bad. It's just a tool, right? It's just an instrument. And at some point in your business, it could be a huge asset. Like you said, a competitor is about to go out of business and you have the opportunity to buy all his inventory or his equipment or, a brand new delivery truck if that's what you need. Wouldn't it be nice at that point to feel comfortable and confident that you can take on the debt, not hat in hand, oh, please loan me the money, but in a way that's going to help your business really make a huge leap forward.
Mm-hmm. Yeah, exactly. And that's why, instead of a business owner, an entrepreneur, saying, well, I don't need those debt things. My business is working good. What they should be doing is working with a trusted advisor, today, like somebody like you, Stephanie, taking a look at where is the business health and where do we need to move to obtain different milestones and, different metrics in terms of just business viability. And part of that equation is using debt as a springboard to better things, to growing the business. And that's what we're here for. And, the nice thing is that there's not a one solution. It's not like you're going down to the bank and saying, I need a X amount working capital loan. You may need something hybrid. And that's the advantage of working with somebody that's can think differently, think outside of the loan box, for example. It's just, I've had customers come to me that are restaurants, and we specialize in restaurants. And they say, well, I want a $30,000 loan because I need to buy, all new equipment, and I have a satellite that I want to put in across town in terms of this is what I want. They come in that way, and I say, well, no, actually, why don't you get some equipment financing that's going to have some of the most superior terms, and then we'll simultaneously put a working capital loan right beside of that, and then that will allow you the expansion capital that you need. And the equation of those two instruments is going to be the pinnacle or the sweet spot of where the business needs to be in terms of its financing or debt needs.
That's really good. I mean, one of the things that, I also have a certification in project management, and one of the things that we would always talk to people about is that you should keep your project management record so accurate that if this awesome opportunity walked in the door, that you could pass off your project to somebody else in a day and explain it to them, and they could run with it, and it would be just fine. And I think that's kind of what we're talking about with a company, a business's credit, you know what I mean, and their financeability is that it should be up to date and ready to go, such that when awesome opportunities do walk in the door, that they can just walk with it, and and it's no big deal.
Right.
So, one of the things that I wanted to ask about is kind of the difference between investors and lenders.
I'm sorry, the difference between investors and
lenders.
And the lenders. Stephanie, do you want to say something on that? Or?
Well, and I think maybe Carmen is talking about the notion of alternative lending a lot of times coming from a different investor pool than the banks, right? And we kind of alluded to it earlier, but it might be a good idea for people to understand why it is that alternative lending pool exists and why it is that banks can't do it. And again, we kind of covered why the banks can't do it, but maybe we talk a little more about who these people are that fund these alternative loan options and why they would do that.
Yeah, well, the banks have a very complex, intricate structure, like I said, based on a lot of new regulatory and compliance environmental structures that they're in. It's just difficult there. The advantage with banks is their access to credit. They can go directly to, the member banks and the Federal Reserve System. Their cost of funds is near zero. But what they can do with it is also very highly controlled. So then you have, on the other side of the fence, you have the non-bank lender who raises funds through, and that could be a whole nother hour discussion, but let's just say it's a different world where they obtain the credit facilities, and they're a lot freer to do what they want with it. And what they want is to make loans. That's what they're in business for. Where banks, they also want to make loans, but they want to make a big commercial loan in one fell swoop to one, big fortune company or a larger. Go ahead. You were saying?
I was just going to say, my perspective is that what banks really want to do is not mess up.
Yes.
What they really want to do is not lose money.
YA.
They want to cover their butt and not make a mistake. And I think, you can cover more of it, but I really think that's the problem, right? Is they're more interested in covering their own butts than they are in making the loan or making a profit.
Yes. The banker is the most nervous species on the planet right now. They get scared of shadows, and I work with them all the time, and everything that I do in terms of some of the consulting that I do with them and their lending initiatives, everything is, well, I got to see how compliance would feel about that. I got to pass that by legal. They don't do anything. Nothing. I mean, if they get a menu out for lunch, you've got 3 lawyers and the compliance officer,
That's interesting. And I guess one part, and I apologize for stepping out for just a second, but one thing that I was kind of wanting to show, and we're going to have our, TK Kugler, who's one of my favorite venture capitalists, is going to come on next week. But one of the things that I wanted to kind of tease apart, there was all these rules, and there's kind of a I don't know, kind of a running scared, sounds like, mentality with banking. It doesn't seem that affected venture capitalists quite the same. We've seen shows like Shark Tank and all of that kind of stuff where, you can go, and it seems like their mindset is that we know in my portfolio I'm going to take a hit on a few of them, so I'm willing to gamble, whereas a bank is not willing to take a hit on any of them.
Yeah, the banks are the most skittish. That's where the problem is that's where the people start first. So they get discouraged right out of the gate. The banker goes, yeah, okay, well, here's our procedures and policies we're going to need, and then they go down this massive checklist, and it looks like you went to the new medical compliance form, and there's 33 sheets, and your eyeballs are you're rolling in the back of your head where you're like, and then you finally get it all. You bring in all of your tax returns and your operating accounts, and then they ask for more information, and that process is long. And then on the 92nd day they say, yeah, we thought about it, you're denied. It's very, very discouraging, and that's where a lot of the business owners, they just say forget it. They either say forget it, there's one end of the bandwidth, or the next guy that shows them any love, no matter what it is, they're like, woohoo, let's go, I'll take it, Well, and then they wake up and they have a credit hangover, and they go, what did I just do? That kind of thing. And so that's where we're trying to get with people first, getting them to get ready and working with a team of advisors, lending partners and everyone else in the circle, getting them in a position to grow their business, the right way, and getting them, ready to access whatever type of lending needs. It might be financing their equipment, or it might be just a working capital loan, and it might be something else, purchase order financing. There's so many niche products out there today that it's one of the most common things is from our clients is, wow, I never thought of that. We get that a lot, and that's where you want to be is looking outside of the actual box and finding more aggressive, better ways to actually fuel the business.
Well, and I think, there's there's so many things I was thinking while you were talking, but you know, you do have to ask, and I think entrepreneurs have to open themselves up to the idea of thinking and asking. You know, even, you know, for me, I have an MBA. I went to school. I did all of this stuff. I didn't know anything about factoring. I mean, you know, it wasn't until, you know, I worked someplace and they showed it, to, you know, explained how it worked and all of that, and I was like, wow, they didn't teach that to me at all. And so, if, you know, and that's for, you know, someone like me who kind of comes from a business background to even have had my eyes open to that option. You know, like when you're talking about invoice financing and things like that for small businesses, it's just one of those things that they don't teach you and they don't tell you.
Yeah. Well, you know, the factoring is another, you know, is another specialty where, you know, invoice factoring, you know, taking, you know, a big, we get this a lot. We get somebody that just had a $300,000 order. They're like, okay, now I need to fulfill that order by buying that inventory. Let's see, that's going to cost me $200,000. They're like, woohoo, I'm excited. And then they're like, where's the money going to come from? You know, so yeah, there is ways to approach that, but that's a really niche, you know, kind of a vehicle, and that's where most people don't know that it's even available. You know, they've never heard of it before. That's why I could do a segment on each of our different types of investment vehicles and probably not put each one of them in an hour segment, because there's really a lot to talk about on it. And then you start blending different vehicles together, and that's where you start finding the sweet spot. And you know, most people in finance, I was never even told a lot about these different vehicles, and they're changing quickly. I was having this conversation the other day with somebody that's in our industry, and they were saying, you know, this is kind of the Wild West in both the good and the bad ways. The Wild West being there's a lot of cowboys out there running around, but the good news is that there's a lot more aggressive products, and the terms are actually, like I said earlier, are getting even better because there's more competition now. As the economy begins to you know, pick up a little steam, market sentiment is better. I am finding that the cost for the identical loan is probably 20-30% less than it was about a year ago. And the trend line looks like it's continuing. So as that happens and the alternative lenders are lending even more money, you get into economies of scale. It starts driving your cost of credit down even more. I mean, that's another whole conversation. But basically all that means is good news for small business owners, because it's looking better and better in terms of vehicles and cost.
Right. And one thing that I think, and maybe this was also part of Carmen's question, is when an entrepreneur is looking at what options they have to finance their business, what is one of the things that differentiates a loan product from an actual venture capital investor? And just so we're clear, the biggest difference is cost, right? Loan products, generally speaking, are going to cost you less because the price is fixed. Essentially what you do is when you agree on the loan amount, you also agree on here's how much interest I will pay you. Whereas when you're working with a venture capitalist, you're not saying here's the fixed amount I will pay you. You're saying you now own 10% of my business. So whatever my business turns out to be worth, 10% goes to you. Now, as Carmen mentioned, that certainly means that there may be times when they get nothing, you know, if your business goes bust, but it also means that if you thought your business was worth $1 million and all of a sudden it's worth 10, they don't walk away with $100,000, they walk away with $1 million. And so it's not, you know, I think that's where getting a feel for what your personal risk profile is very important. Because for some people, the idea of paying someone to use their money feels very strange. But to other people, the idea of having a partner in your business feels very strange. You know, so that would on one hand eliminate maybe the debt, and on the other hand eliminate the equity partners. So there's not a right or wrong, is what I'm trying to say, but you really need to know what's right for you. And one of the first steps clearly is to educate yourself about the range of options you have, within lending, which is what we're doing today, and then, within the venture capital, which is something we'll get to in a later show.
Right.
I don't know.
And
go ahead, Carmen.
not to totally go down that rabbit hole, because I do want to save some juicy bits for TK. But one of the things that I think that people are not so much aware of with venture capital versus debt is that, if you go to a venture capitalist, they essentially do become your business partner, even though they're only 10% in or whatever. They can come in and start kind of managing things and changing stuff around, and they own a piece of the business, whereas a bank might give you a loan, but they're not going to tell you to come in and tell you who to hire, who you should be talking to, why are you talking to this company versus that vendor. I mean, they're not going to be as involved as, say, a venture capitalist might be.
Right, and maybe that's another myth that we might want to address. I wrote down a few myths, some of which we've already touched on, but I think a lot of people have this notion that if I borrow money, the bank owns, I've seen people say that, the bank owns my business. I don't want the bank owning my business. So maybe you could talk to us about that, Terry, the notion that the bank never really owns your business unless you're in default.
Yeah, no, it's bankers, alternative lenders are never going to tell you how to make your tacos or where to open your next restaurant. So we don't have any kind of ownership position within the company, and you have the ability to, once you've obtained any kind of financing, working capital, and those funds are now in your control, it's all you in terms of how you want to utilize the funds. And that's why you got to understand that if you're a good operator with those funds, then we see people that work with us all the time that come back in 3 and 6 months and they've just doubled or tripled their position and they're ready for another round. That is not uncommon. I'm dealing with a business in Hawaii that is on his 3rd loan, and I've seen his accounts go from sub 10,000 a month to now he's over 150,000 in revenue on a monthly basis. So, I didn't say, look, I want you to make surfboards this way or whatever. I can't even ride a surfboard, so you're asking the wrong guy. So, no, we have once you get the capital, you're out of the gate, and the race is yours to run.
Right, and maybe that's, if we try to bring it back to what we as entrepreneurs can control, we can put our best foot forward, we can manage our business to the best of our ability, but ultimately for us to be successful when we borrow, it sounds like we need to have a very clear idea of what the money we're borrowing is going to be used for. We need to know how it's going to springboard us forward or catapult our business or whatever. And then we also need to have a very clear understanding of what can happen when things go wrong. Right. Is there any other pieces we really need to kind of keep in our minds as we're going in this process?
Well, you made you hit the highlights there. Why? The question of why are we doing this? And a lot of people will go, well, I've got a tax liability coming due here, in the next 30 days, it's okay, so we're going to incur more debt, to handle this. I understand it's a panic mode, but is that going to be the best solution for you, or there might be some other things you want to look at? So in other words, having a mini plan for the as soon as you have the capital land in your lap, it's not like, okay, now what do I do with it? Most business owners have a general idea, but what they should be working with is a team of trusted professionals to say, look, why don't you allocate this percentage over here just on a reserves cash basis, and then why don't you take this percentage over here and go ahead and do what you were going to do. And it's not uncommon that somebody will come in for 30,000, we'll grant them maybe 40 or 50,000, and they'll ask why. And that's why I say, look, let's structure this just a little bit different than what you were thinking. And I know that normally your average lender, your banker, it's outside of the scope of what they usually do. But if I may add some benefit to the cause here, I think that you should be looking at these things and putting together a plan. And a plan being not only a plan that you have, but maybe you should work with a trusted advisor outside of me or somebody else that is in a position to say, look, I think that you're looking at some things wrong here. Why don't we structure it this way? Nothing wrong with having a second set of eyes on what you're doing and having a well thought out plan.
Sorry, had to unmute myself. Just one quick question, and it's a kind of a tough question, but I always put it at the end to just make sure that we keep it real short. The answer: if you could, if you became the finance chairman for the country or something like that, and the everything was kind of your oyster, and you could spin it how you want, what would you change about the way our banking system is set up to help more entrepreneurs and business owners?
Well, first you need to locate me someplace that's really warm. New Zealand looks nice. Or we could move it to Hawaii. I would start with one of those. That'd be my first motion. I think that, this is going to get me in trouble with all of the powers to be, but, one of the things that I see is the way our money system works in general, which is, not to go off on kind of a tangent, but it's important and relative to what we're discussing today. I really support like some of the institutes for public banking and some of the other ways that, banks are structured. And you got to understand, too, that I'm a real proponent of actual credit unions, which are getting more aggressive in all types of lending, because a credit union is a member-based nonprofit. And most people don't know that. I mean, you get a national bank that I've worked for the national banks, but they're there. And they're a behemoth that's profit motivated, and that's not an epiphany, but they're there to profit the major shareholders or stakeholders in the banks. So you get into credit unions or public banks like North Dakota, and you see the results of those enterprises. You have healthier communities, healthier states, and that's what I would do. Is I would radically overhaul our credit and money system. And it's been done before. It's just, do we have enough awareness out there? And the answer is no right now. There's a lot of initiatives that I support that could actually allow this economy to recover much faster than it is right now. Because the banks are sitting on over $2 trillion, and the key word is excess reserves, money that they're not lending to you and I, and that's not a good thing, because small businesses are the bulk generator of new jobs. And unless we get our money system right, and unless we get, our jobs and our economic engine right, the other things that we do all the way down to just the family level and societal levels are going to suffer. So that's kind of a long answer, but that's my view on some of those things.
No worries. That's an intentionally loaded question. So you did a great job, and thank you so much for coming on. Not just that question, but all of the questions this whole hour. Every time we do these talks, I feel like I know more about what, even for me, what I need to do with my business and how to move forward. So I really do appreciate your time. And Stephanie, as always, your questions are so insightful, and I really appreciate you coming on as well to help share with our audience what they need to know about finance. And real quick, speaking of our audience, I just wanted to, we were just going so fast, we never did get the chance to just recognize Tanya Rufus is out there. Hi, Tanya. Thank you so much for watching. I'm so glad that this is helpful to you, and I really hope that the information that we shared, you share it, keep moving it forward so that people learn from great guys like Terry that there are good bankers out there. There are good people. They're not all sitting back, with their little pet cat and sitting in the office. So they don't all wear a top hat and coattails.
The monocle.
Yeah. The little eyepiece with the chain on the That's great. So this was
on Halloween.
Like the little guy in Monopoly.
Yeah, I was just thinking that actually.
But this has been great. So I really appreciate your time. Again, join us next week. We will have, it'll be the last of our 4 sessions, and we will be talking with TK Kugler. He's a venture capitalist here in New England area. And so we'll be tackling that side of the financial puzzle as well. If you have any questions or comments for Terry, please go ahead and post them there in the comment room. Those of you on YouTube or watching us on any of our other channels, we check those too. So if you leave those questions there, we will make sure and share those with Terry so that we can get answers for you. Thank you so much. Say goodbye, everybody.
Thanks so much for
Bye.
coming, Terry, and thanks again for doing this, Carmen.
You're welcome. Thank you.
Great. And we'll see you next week. Have a good day.
Okay.